How to invest if we really have big inflation? Now today, let's talk about worst case scenario. What if inflation runs at 5%, 10% and everything goes up in price? What can you actually invest in to really be safe in that situation? I've previously suggested through research that REITs typically do well in high inflationary period. That has drawn a lot of criticism, and some of the common reasons, which I'll try to debunk right now, are that REITs have borrowing costs, which means if interest rates go up, the net property income would drop because more cost is paid to interest, correct? That is partially true, but if you think about it, how REIT managers approach it is like how you approach your own mortgage. You can lock in fixed rates, correct? Right now, DBS, if you want to lock in fixed rate, is at 1.68% for 5 years. REITs also have certain fixed rates, so they are not all exposed if interest rates inch up. The second common concern is that REITs, if the interest rate environment increases, the yield spread drops. That's why the REIT price must drop to give a better yield. A similar concern as to a bond investment. And that is partially true, but you think about it. When interest rates go up, when there's inflation, typically the economy is doing quite well. And REITs, they can actually revise their rental rates. For example, 313 Somerset, Lendlease has actually increased their rental rates. And not only that, some REITs have even an escalating factor of 3% inbuilt into the REIT agreement with the tenant already. So they are different from bonds. They are not totally a fixed amount they can receive. They can actually inch up along the way when the situation changes. In that case, check out the video, which I'll leave towards the end of this. But today, I want to talk about what you can invest other than REITs if you are really looking to understand what will typically survive well. And I'll use firstly some suggestions from Warren Buffett in a big picture kind of overview. Then I'll round up what are the strategies that you need to adopt so that when you invest, you sleep safe with it. With that, let's roll in the intro video. Hi guys, welcome back. Without further ado, let's start with what Warren Buffett has to say, because he's seen before real inflationary periods. I'm not that old. I haven't seen before, the 1950s, 1960s, where inflation was running at, above 5% rate. So let's tap a bit on his wisdom and what you realize in this article. Warren Buffett says these businesses do the best during periods of high inflation. And when that question was asked during the Berkshire Hathaway's shareholder meeting, his response was, the best business to own is one that doesn't require continuous reinvestment because it becomes more and more expensive as the value of the dollar drops. And to further elaborate, he mentions that the best businesses during inflation are businesses that you buy once and you don't have to keep making capital investments subsequently. Any business with heavy capital investments tend to be a poor business to be in inflation, and often it's a poor business to be in generally. And using his wisdom, let's look at some local stocks to really run through the concept. The first idea that comes to my mind obviously is SIA again. I've said before many times on this channel, SIA requires a lot of capital for its aeroplanes. So that, I assume, you already understand, it requires capital investments all the time. A second name, SembMar. SembMar ironically is showing some life right now in terms of share price, but today we're talking big picture. In the short term, share price can go up and down. It's a voting machine. But in the big picture, long term, SembMar requires capital to build its ships, build its rigs, etc., etc. And it falls under what Warren Buffett says require capital investments. Other notable names include KEPPEL CORP, include SEMB CORP, and these are heavy industrial players. And what about a more familiar brand like F&N? F&N manufactures milk and drinks. I'm sure you have consumed that before, but they mainly are a manufacturing company. And what about companies like telcos, Starhub, Singtel? Do they also require a lot of capital investments? And what about other dividend plays that are commonly mentioned in comment sections? I check out each and every one of them. Names such as Netlink Business Trust, which has a near monopoly on residential fiber, but of course is very asset heavy. They own the network assets itself, correct? And what about for Keppel Infrastructure Trust, which owns a lot of essential assets in energy and in sewage? The share price for these two are relatively stable, but do they fall under the category of what Warren Buffett mentions, that they require a lot of capital investments? In any case, the dividend that they pay out typically is quite flat, and investment in them looks a bit more like a bond in my opinion. So if you follow my train of thought, let me suggest to you how you can actually filter for stocks that might interest you a bit better if you're concerned about inflation. Firstly, look at the ROA of the company. Filter in your shortlist for ROA because ROA is return over asset. And if a company is a heavy capital investment business, the ROA is typically low. Let me show you some examples. F&N for one, the ROA is only 2.01%. SEMB CORP, 2.72%. ComfortDelGro, who owns fleets of taxis and buses, 1.88% in ROA. On the other hand, if you look for SBS Transit, it is at 10.74% because SBS rents the bus and earns money from commuters like you and I. So they are more like a service business. What about Sheng Siong? Sheng Siong's ROA is 13.86. We understand Sheng Siong has assets like warehouses, like retail shop space. But the key difference is their profits are not solely because of their assets. So ROA is a way you can filter away companies. With that, let's move on to the second rule. Let's read what Warren Buffett has mentioned also further. Brands are a wonderful thing to own during inflation. In his example, he uses See's Candies, which he has owned since 1972. And See's Candy is obviously a candy brand, but they've been able to increase the price of it along the years. It's just a bit like Bangguang Solo. My favorite is Bangguang Solo's pandan cake. And right now it's already at $3.70, where last time when I was younger it's like $1 plus only. He also mentions that no matter what happens with the value of the dollar, the business product will still be in demand. And last but not least, he mentions that it's particularly handy to own real estate during times of inflation. That is why the REIT logic still makes sense. But let's dive back on brands. So what are brands that you can potentially buy? I think the clearest example is Apple, correct? Apple's listed in US. Apple's products like iPhone, I'm using it right now. Apple's Mac, I'm using it right now. And when we talk about brands, which brand is a more luxurious brand than LVMH? LVMH owns Louis Vuitton, something which I've covered before in a previous video, and it's actually listed in France, and to invest in it, perhaps it's easier to go through funds. But in Singapore's case, what are some brands that we can think of? F&N owns brands, correct? 100 Plus, Magnolia, Oishi. But the ROA test will have failed F&N. So thinking about brands in Singapore, I can suggest The Hourglass. The Hourglass retails Rolex, which definitely will still be in demand. And it's arguable that when inflation hits hard, people want to store their wealth into luxury watches because they can preserve that wealth just like any other asset. So if you're concerned about inflation, keep in mind that logic of brands, and we'll move on to the third rule, which is something I formulated myself. Now, if you have benefited, smash the like button because it's taken on team hours to produce this valuable content for you. And again, invite you to press and subscribe, especially if you enjoy investment topics and retirement planning concepts. Now let's talk about something that you need to understand about an inflation world. In that world, everything rises in price, correct? Your income increases because you demand a higher wage from your boss. But also, everything around you becomes more expensive. You go to a hawker center, it's more expensive. You pump petrol, it's more expensive. Everything increases. Your revenue increases, but your cost of life also increases. That is also the same situation that is faced by businesses. And that's why you need to be very vigilant on looking for companies that are able to manage their costs well. Let me elaborate further. Let's use Q&M as an example. They are a dental business, correct? And as we know, dentist industry is labor tight. Costs is not easy to control because if dentists require a higher wage, you have to pay them to retain them. And if you compare against, for example, Sheng Siong, where the staff are a bit more expendable and easily replaceable through training, you can guess who can control costs a bit better. Same with the Hourglass. Their retail staff over there can be easily trained, unlike a dentist which requires 4 or 5 years of specialized training. So it's not just what business to own, but what business is able to increase its revenue with inflation and keep its costs managed. That will actually be the key deciding factor. If you agree, help me smash on like button. With that, I'd like to suggest an easy concept if you are concerned about inflation when you approach your investments. What about banks? Banks make money through financial sales and loans. And if you think about these two products, they are intangible. They don't need a factory to produce it. Financial products are usually a contract, like a loan agreement or interest-bearing account. All these are intangible. Are banking stocks a low-hanging fruit when it comes to investments during an inflationary period? And to add things further, when interest rates go up, banks typically make more money through net interest margin. So if you agree on bank stocks, then we already have the big three names in Singapore which are very sound: OCBC, UOB and DBS. And if you're curious as to which is the better investment, perhaps check out this previous video I've done before. How to compare between these three fabulous banks. And with that, maybe I'll explain a bit more on their business for you to get a grip on which might be your personal favorite. With that, I'll sign off from this tutorial and see you there too. Take care and goodbye.